think people need to do is take a moment, zoom out, look at history, right? So we tend to forget that in 2007, the Fed cut by 50 basis points. It was actually on the exact same day, September 18th. And what you saw during that first, or at that first rate cut, is CPI running at around 3.5%, if my memory serves me well. And then what they did is they cut another 25. They cut another 25 just that year, right? And then going into 2008, they're supposed to have a meeting January 29th. They actually had an emergency meeting January 22nd because things got so bad, where they cut by, I believe it was 75 basis points. And then a week later, they cut by another 50 basis points. So these massive interest rate cuts, okay? Now, during that time, what was happening as far as the narrative is people were saying that they're cutting too much. Inflation is going to reaccelerate, which oddly enough it did. So if you look at that first rate cut, 3.5% in the CPI, and we can debate whether that's accurate or not, we're just looking at the trend. If you fast forward to August of 2008, the CPI went from right around 3.5% up to 5.6. 5.6. And this was August of 2008, all right? So then if you read the Wall Street journals around that time, which I like to do, I like to go back and read the old Wall Street journals. When the CPI report came out in August for July and it printed the 5.4, 5.6, what the narrative was back then is the Fed is gonna have to start hiking rates. So going into the end of the year, they've made this huge mistake. They're way off sides. They cut interest rates way too low because they're afraid of the boogeyman. The economy isn't doing that bad, even though the stock market went down. So now they've let the inflation genie out of the bottle, so to speak. And now we've got to worry about not disinflation or deflation, but we've got to worry about a reacceleration of consumer price inflation because the Fed has totally lost control. And oh, by the way, the 10-year Treasury yield from that time in January 22nd to August, it went up. It went up. So they're saying, look, the Fed has lost control of the long end of the curve. And the biggest concern that we have is a reacceleration of consumer price inflation. This was August of 2008, and I'd like to remind the viewers that just 2 or 3 months later, interest rates were at 0. And you fast forward about a year, and the inflation rate was -2. In other words, 2% deflation, not even just disinflation, deflation, right? So what I'm saying is, I'm not using that example to predict and say we're going to see the exact same thing in 2025 that we saw in 2008. But what I am saying is just because we see interest rates along the curve go up after the Fed cuts, and just because we see the CPI go from 2.4 to 2.6, doesn't necessarily mean that there's 100% probability that we have let the inflation genie out of the bottle. And then if you go back to 2001, you see that to a lesser degree, we saw the same cycle, that once the Fed cuts rates, the 10-year Treasury yield actually goes up. It doesn't usually go down for quite some time. But then what happens is what the yield curve is predicting, that usually over the next year or year and a half plays out once the Fed starts cutting rates. When you look at the yield curve, the crash or the recession or whatever you want to call it, the hard landing, it rarely occurs when the curve is actually inverted. It usually occurs after the Fed starts dropping rates, and that's what makes the curve steepen out and uninvert, and that's when the stuff usually hits the fan. Usually. Now, it could be different this time. It absolutely could. But what I like to do is just go back and look at these cycles, going back to the 1950s, and say, okay, 95% of the time, let's say it plays out this way. So in this business that we're in, there are no certainties, there are only probabilities. But what we have to see is that it usually plays out this exact same way, and the end game, if you just fast forward a year or two, is very rarely a reacceleration of consumer prices. It's usually disinflation that's then followed by an acceleration of inflation due to the response mechanism from the central planners. So that's my base case right now, and that's just based on what has happened over the past cycles.
Yeah, a lot of analysts are questioning, they almost have to cut. I mean, can the Fed even afford not to cut at this point?
Well, I think what you have to ask is, why did they cut in the first place? Like, why did they cut 50 basis points? It's not because the economy is booming, and I get it. They're no more focused on unemployment as opposed to inflation, but they're doing that because growth and inflation expectations are declining. You look at the SOM roll. I'm sure you guys talk about that all the time.
Yeah, we had Claudia on.
Yeah, I mean, that's a great indicator as to just that in and of itself. Look, when you see that go up by 50 basis points or whatever it is, you're usually very close to, if not in a recession. So it's not just that. If that was just the only indicator that we had, I'd say, okay, well, maybe it's wrong because of X, Y, and Z. But you look at that, you look at the inversion of the curve, you look at all these other things. I mean, even the wildest bull that you guys have on your channel would sit there and say that the poor and middle class is doing well right now. There's no way. You cannot argue that, right? So then it becomes, well, why is the upper class, why are they doing well? Well, it's because of asset prices. Okay, so what you're telling me is the entire US economy is built on asset bubbles.
Yeah.
And yes, those bubbles may be able to continue into the future, but they can't continue indefinitely into the future, right? So then you have to say, okay, what is the pin that's going to prick that bubble to where it'll impact the aggregate demand of those people at the top to where they join the poor and middle class, and then that's usually when you see a recession. It doesn't mean you have an absolute crash like the GFC or the during COVID or something like that, but you just see a balance sheet recession that may be very similar to what we saw in 2001. But oh, by the way, the Fed dropped by 50 basis points to start that interest rate cycle as well.
Okay, well, you and I chatted a little bit off camera just about how crazy it's been culturally. There's been a big shift. So Trump has come in, there's talk about Doge, there's talk about efficiency, cutting costs. Nobody really ran on a mandate to decrease debt. What are your thoughts here? How has it changed?
Well, on that note, I'm very bullish. So, you can have reasons for being bearish and bullish, and it's all about net balance, right? So, I'm very excited, at least from a cultural standpoint, like you said, I'm very excited because what I'm just observing, doing all my videos and being neck deep in the news every single day, is we've gone from, just a simple example, we've gone from the football players taking a knee during the anthem, saying how it's basically cool to be a victim, right? To now the football players are in the end zone doing the Trump dance, right? Which for me just indicates that there's been this big shift culturally in the United States where it was cool to be a victim, but now all of a sudden it's cool to be successful. And maybe we can extrapolate that, I'm hoping we can, to it was cool, big government was cool. It was cool for the government to take care of me because I was a victim. But now all of a sudden, well, maybe that's not cool. Maybe I better take personal responsibility. And maybe we need to understand how inefficient this bureaucracy is that is the federal government. And maybe it's cool to start shrinking that. And that's what we need. It reminds me, I was very young going into the 1980s, but it reminds me of kind of that Thatcher era or Ronald Reagan. And the proof that I would give to you is watching like Elon on Joe Rogan, where 3 or 4 years ago, Joe Rogan was talking about how, we should expand government through Bernie Sanders and this and this and this. And now all of a sudden he's getting on there with Elon, and Elon is really influencing him to look at it from a different standpoint, that we need to shrink the size of government, and that's actually the path forward. And Joe Rogan obviously has a massive, massive audience, huge influence, right? And so when you have all these younger males that are watching Joe Rogan, looking up to him and he's saying and agreeing with Elon, and then they're rethinking it and saying, well, man, maybe all these things that my teachers taught me about socialism, maybe that's not the best path here. Maybe that's not the best thing that we need to do. And so for that reason, it's all about net balance. But for that, looking at it through the lens of culture, I'm very, very excited about what we have in the United States because, and I go into this in my presentation, I don't think we have a debt problem. And that's probably
unpopular opinion.
Yeah, that's probably a little bit different than most of your people that you interview. The reason I say that is because we look at interest rates right now, and we've got the 10-year trading under Fed funds still, even though the 10-year has gone up. If we had a debt problem, that would be reflected in interest rates. If Fed funds is at 4.5%, and we had a debt problem, meaning that we've got all this supply that's coming on, we have all this demand that's deteriorating because all these foreigners are dumping treasuries, and they look at the off-balance sheet liabilities, whatever, and they say there's no way I want to hold treasuries anymore. The interest rate on the 10-year would not be under Fed funds. Right. It would be 8%. It would be 9%. Right? So since you have an inverted yield curve, that in and of itself tells you that there's massive demand for treasuries. Just look at the price. Don't take my word on it.
Yeah. I mean, one could argue that China and Japan just dropped billions, hundreds of billions of dollars in treasuries, but was it strategic? Yeah.
But who picked it up? All the banks in the Cayman Islands. Right? And why did they pick that up? Because what really matters to interest rates at the long end of the curve isn't necessarily supply. This is where most people get confused. It's really it's really growth and inflation expectations. So let me give you a quick example. Let's say you're a bank in the Cayman Islands, and on the liability side of your balance sheet, so your dollar funding, you're paying 2%, right? 2%. And let's just assume that you can match up the maturity with your deposits with a treasury. So let's say that you have a time deposit of 2 years, right? And that's $10 billion, and you're paying 2% for those dollars. How many treasuries would you buy? Yeah. The answer is limitless. Yeah. There is no limit to the number of treasuries you could buy. 2 year, you could match up maturity. If you can pocket the spread, that's all you care about, because your dollar funding costs are 2%, but yet you can get, let's just say 4% on that treasury. You're pocketing the 2%. You don't care how many 2-year treasuries Janet Yellen issues, because you're going to buy more. And what happens is, if the interest rates go up because of supply, you're just going to buy more that will bring them back down to the fundamentals as to what moves rates at the long end, which is those growth and inflation expectations. Because if you think that growth and inflation is going to be higher, then you're going to take that balance sheet capacity and you're going to allocate it to lending into the real economy as opposed to buying the treasuries, and then the interest rates go up because of that inverse correlation between price and the rates themselves. So my point is, I don't think we have a debt problem, but the problem is the spending. This is the problem. Yeah. Well, it is sustainable, unfortunately. And what I say on my videos all the time is the problem with the debt crisis is there's no debt crisis. Because if we did have a debt crisis, that would actually constrain government spending. The problem is we don't have a debt crisis, and there's going to be, banks out there that are willing to buy this debt because of that spread, that dynamic. It's one of the dynamics that we just talked about. So this gives the government basically an unlimited credit card to sit out there and spend and spend and spend. And the problem with that government spending is that's what distorts the economy. Yeah. It's so a lot of people will sit here and say, well, my goodness gracious, if we could just get the government spending back down to 50% of GDP, well, that solves all of our problems, because then the foreigners are, with all this additional supply, there's going to be balance sheet capacity, there's going to be demand. No. That makes the problem worse. It's the example of the heroin addict that I always use. So let's say he's got a credit card, he runs it up to 100,000, injecting more and more heroin into his bloodstream that destroys his body and destroys his mind. And you say, well, the problem, obviously, is that he maxed out his credit card. So let's just go ahead and give him another credit card. Are you helping him or are you hurting him? No, you're hurting him, because now he's going to inject more heroin, and that's the problem. The debt isn't the problem. It's the fact that he's injecting heroin and more of it into his bloodstream and destroying himself, killing himself, right? And that's the way you have to look at the U.S. economy. It's the injection of heroin. It's the government spending. It's not just getting the debt under control to where it's 50% of GDP as opposed to some arbitrary number, let's say 125 or 120%. So going back to why I'm bullish, when we get this talk from all these influential people of reducing the size of government, that's what really gets me excited, because I know that's the real problem.
So spending will be cut. I mean, since July, we've added $1 trillion deficit to the 36. Like, it's getting out of hand. How do we diminish that? It's not going to be just Doge.
No, and again, I don't know that should be the focus. I think the focus should be first and foremost on reducing regulations, because this is what I'm talking about. You reduce regulations, you reduce the size of government, then you free up the marketplace to go ahead and create more goods and services. And at the end of the day, that's the real wealth in society. It's not dollars, it's not gold, it's not silver, it's goods and services, right? So if a society, can produce more goods and services more efficiently, this will increase the wealth, this will increase the standard of living. And that's a separate question from what's going on with the debt. So I think we have to focus what they're focusing on, which is reducing the regulation, reducing the bureaucracy, reducing the red tape, cutting the government employees just 50% straight across the board, I think would be a great start. And then what you're doing is you're freeing up the human, all the resources that we have in the United States and that entrepreneurial spirit, the animal spirits that Keynes talks about, you're just releasing that. And then I think you're off to the races. And I think that growth will compensate for a lot of the current problems that we have.